Hi, my name is Darrin Mish, and I'm a tax attorney with a national tax problem resolution practice based in Tampa, Florida. During my 15 years of practice, there are questions that arise again and again, so I thought I'd take this opportunity to make some videos and answer those questions in this video format. There are 20 videos altogether, and if you'd like to have access to the other 19 videos, please visit my website at getirshelpvideos.com. The next question is there any way to negotiate with the IRS? And the answer is yes, but not in the way that you're thinking. You know, oftentimes when people contact an attorney, for example, for a car accident, they say or they think that the way that negotiation happens is you're on one side, let's say you're the plaintiff's lawyer is asking for $100,000 and the defense attorney is wanting to pay $5,000, and somehow they arrive at a number in the middle and they pay $50,000 or $60,000, and they think that that's how tax liabilities are negotiated and that's how it ought to work. And I'm here to tell you that's not how it works at all. See, the only way that the IRS can really compromise the liability, reduce that liability, and forgive tax is through a program called the Offer and Compromise Program. There's actually three types of offers. There's something called a cash offer, a short-term deferred offer, and a long-term deferred offer. And I'm going to take this opportunity to explain each of those offers in just a moment. Now, this is not horse trading style negotiations like there are in many lawyers' negotiations. This boils down to numbers and figures, and you end up arguing over things called allowable expenses. So let me give you an idea of what a cash offer is. A cash offer is an offer payable within 5 months of the acceptance of the offer. Now, keep in mind that's not 5 months from today, and it's not 5 months from the date that the offer is filed. It's 5 months from the date of the acceptance. And at the time of this recording of this video, most offers are taking somewhere between 6 and 12 months to be thoroughly investigated and to be either accepted or rejected. The key there was accepted or rejected. There's a great number of offers are actually rejected, and I think it's in part because lay people try to file their own offers in compromise, or because there's a great number of unscrupulous national tax-based tax resolution firms in the country that will file offers in compromise for just about anybody, whether they're breathing or not, or above ground or not. And that's not something that we do here. Of the offers that we actually file in our firm, we have a tremendous success rate for those that we actually file. See, not every client is an offer in compromise when you call my law firm. Now, let me tell you a little bit about a cash offer. A cash offer, as I said, was payable within 5 months of the acceptance of the offer, and it actually boils down to an algebra problem, and let me explain that. It goes like this: monthly disposable income times 48 plus the value of your assets equals the amount of the offer in compromise. So let me put some numbers to that so that you can better understand, because it's hard to visualize. If you had $50 a month, monthly disposable income, and you multiplied that by 48, and then you added in the value of your assets, then that equals $2,400. Assuming zero assets, then that would be $2,400. Now, it doesn't really matter how much you owe the IRS, whether you owe them $24,000 or $240,000. If we are successful in demonstrating that your monthly disposable income was $50 and you had zero in assets, then you should be able to settle your case with an offer in compromise for a cash offer of $2,400. Now, what does monthly disposable income mean? Well, the monthly disposable income is the difference between your total income and your monthly allowable expenses. I made the quotation marks because allowable means what the IRS says it means. There's actually national standards, and there's charts and graphs where we can get the maximum allowable expense categories for a variety of things like housing and utilities, food, clothing and miscellaneous, transportation, and so on. So let me explain the short-term deferred offer. It's similar to the cash offer, but it's a little bit different. A short-term deferred offer is an offer payable within 24 months of the acceptance of the offer. The algebra problem goes like this: monthly disposable income times 60 plus the value of your assets equals the amount of your offer, but divided by 24, because there's 24 monthly installments. So let's use that example that we did before. If you had $50 monthly disposable income and zero assets, it would go like this: $50 times 60 plus 0 equals $3,000. $3,000 divided by 24 is $125 a month for 2 years. Now, you might ask yourself, if all you can afford to pay is $50 and you've demonstrated that to the IRS, how in the world do they expect you to pay $125? Well, your guess is as good as mine. But I can tell you in practice, what happens is friends or relatives usually make up that difference between the $50 and the $125 by loaning $75 a month or making the payment for the taxpayer. So that's a short-term deferred offer. A long-term deferred offer is actually an offer that is payable over the number of months remaining on the collection statute. Now, I actually did a whole separate video about what the collection statute is, but let's suffice to say that in this particular case, it's going to be 10 years. Let's say you just filed your returns, and there's 10 years for the IRS to go ahead and try to collect from you. So if there was 10 years left, then your offer would go like this. Your offer calculation would go like this. Assuming $50 in monthly disposable income and 0 assets, it would go like this. $50 times 120, in this particular illustration representing 120 months, plus 0 equals $6,000. But that's $6,000 divided by 120 months, which is $50 a month for 10 years. Now, would I actually advise you to do that? Probably not. I think 10 years is a really long time. And keep in mind, you have to make those payments on time perfectly for 10 years without making a mistake. If you make a mistake, they're going to default your offer, and all the tax penalties and interest are going to come roaring back, and you're going to have an even bigger problem on your hands. Now, there's something very important that I wanted to tell you about the offer and compromise, and that is that after your offer is accepted, your tax liens will be released, will be extinguished. You won't owe any more money, so there's no penalties and interest, so that's a good deal. But there's also a 5-year probationary period after an accepted offer and compromise. What does that mean? That means you have to file and pay on time, no exceptions, for 5 years. But hey, you're supposed to file and pay on time anyway. So once you've been through this hell and someone's actually helped you get out of it, I think that's the least that they can ask of you, is to file and pay on time. There's really no other way to negotiate with the IRS in terms of reducing actual tax unless you're going to argue that you don't owe the tax in the first place. That's really all the time I have for you today. If you'd like to have access to the other 19 videos in this program, I urge you to visit our website at getirshelpvideos.com.